Okay, in this segment of Chapter 5, we're going to discuss the contribution margin ratio. And we're going to use this contribution margin ratio, I apologize for the typo there, ration, to compute changes in contribution margin and net operating income resulting from changes in sales volume. Contribution margin ratio, first off, is very similar to the gross margin percentage, the gross margin ratio, another term that you're familiar with from other accounting classes. The contribution margin ratio is calculated by dividing the total contribution margin by total sales. For instance, it can be done on a total basis or on a per unit basis. So in looking at our example here of Racing Bicycle Company, they sell each bike for $500. Their variable cost is $300. Contribution margin $200. The contribution margin ratio is the contribution margin divided by sales revenue. In total, that would be $100,000 divided by $250,000, as the slide shows, or on a per unit basis, $200 divided by $500, 40%. This is just the solution or the computation as to how we get there. Contribution margin per unit divided by sales price per unit. Contribution margin can also be calculated by dividing contribution margin per unit by the sales price per unit, as we talked about. Contribution margin ratio, all right, when Racing Bicycle increases sales from 400 to 500 bikes, in other words, $50,000 of additional revenue, contribution margin will increase by $20,000. $50,000 of sales revenue multiplied by 40%. Proof of that is seen in the table below. All right, you can see that sales revenue, okay, at 400 units is $200,000. Less the variable cost, less the fixed cost, that was our break-even point. When we sell 100 additional units, we will increase revenue by 50 grand, 100 times 500. All we need to know, therefore, is that that results in an increase of sales revenue of $50,000. That $50,000 of sales revenue, given a contribution margin ratio of 40%, will increase our contribution margin by $20,000. $50,000 multiplied by 40%. Therefore, our contribution margin will increase from $80,000 to $100,000, a $20,000 increase. So a $50,000 increase in sales revenue results in a $20,000 increase in contribution margin. I'll skip through these couple of slides. Therefore, the contribution margin ratio is the relationship between profit and contribution margin ratio. Can be expressed in this equation formula also for students that like this as opposed to the ratio formula itself. At this point, what I'd like you to do is I'd like you to turn in your book to page 213, and I would like you to work on exercise 5-4. Exercise 5-4 at the top of page 214, page 214 in the book. Exercise 5-4. You can stop the video now, and when you come back, I will discuss the solution to exercise 5-4. We will now review the solution to exercise 5-4, which is on page 214. If you look at exercise 5-4, it deals with the Harrison Creations Incorporated, which sold 40,000 units. When they sold these 40,000 units, total sales were 300 grand, variable costs were 240 grand, fixed costs were 45,000. The first question asks us, what is the contribution margin ratio? Well, the contribution margin, first off, has to be calculated in order to calculate the contribution margin ratio. Contribution margin is simply total sales minus variable costs, 300 minus 240, or $60,000. That contribution margin divided by total sales revenue gives us the contribution margin ratio of 20%. So if we take contribution margin of $60,000 divided by total sales of $300,000, we have a contribution margin ratio of 20%. Part 2 of this problem asks us to estimate the change in the company's net operating income if it were to increase its total sales by $1,500. So, if they were to increase their total sales by $1,500, The simple way to do this problem would be to take the change in total sales of $1,500 multiplied by the contribution margin ratio of 20%, and we would figure out that the change in net operating income would be $300. In other words, because of an increase in sales revenue of $1,500, our net operating income would increase by $300. You can take it a little further if you wanted to. If you don't trust or don't feel comfortable doing that, you could work it out the long way, as demonstrated here in the problem, where you have total revenue of $300,000 divided by number of units sold, 40,000, gives you $7.50 per unit is the sales price. If you were to take that increase in total sales of $1,500 divided by $7.50, that would mean that you would sell an additional 200 units of product. So now, instead of you selling originally 40,000 units, you would now have sales volume of 40,200. Now you could work through this contribution margin income statement by changing both the sales revenue and the variable cost to reflect 40,200 units. 40,200 units at $7.50 would be your sales revenue. Okay, $40,200, or simply from there multiplying it by 20%. Okay, you would get your contribution margin of $60,300. You could back into your variable cost, which is the difference between sales revenue and contribution margin. Less your variable cost, you see that net operating income is $15,300. The change between the original and the new, $300. What I would really like for you to get out of this class is not so much rewriting contribution margin income statements, but being able to take these shortcuts. I think the value in this is sitting in a business discussion with somebody and being able to quickly know or tabulate changes in profit based on changes in sales price, volume, variable cost per unit, fixed cost, etc. If you're able to understand these relationships, you don't need to scratch out a whole income statement. You can do this simple math very easily and make your decision making a little more efficient. This does it for the solution to exercise 5-4. Now we will go back to the lecture. Now we will resume with learning objective 4, which will want to show the effect on net operating income when we change the variable cost, fixed cost, selling price, and volume. First off, one thing that you may have noticed right away is we've been talking about the contribution margin ratio. The inverse of the contribution margin ratio is the variable expense ratio. When sales revenue is assumed to be 100%, if your contribution margin ratio is 40%, well, your variable cost must be 60%. So 100% less the contribution margin ratio is your variable cost ratio. Or simply by taking your variable cost of $150,000 divided by sales revenue of $250,000, you come up with the 60% variable cost ratio. Here's a question that we'll want to be able to learn how to solve. And let's look at this question. It says, what is the profit impact if Racing Bicycle can increase unit sales from 500 to 540 by increasing the monthly advertising budget by $10,000? Well, if monthly advertising is increased by $10,000, that means our fixed cost is going to increase from $80,000 to $90,000. So that is the first thing that we want to see. Secondly, we're going to sell 40 more units at a sales price of $500 per unit. That is going to change our sales revenue by an additional $20,000. We will now have $20,000 additional sales revenue added on to the original $250,000. We come up to $270,000 of sales revenue. Our variable cost will also change. So keep in mind, when your sales revenue changes due to volume, your variable cost must also change. Alright, so our variable cost must now represent 540 units sold. 540 units at $300 a piece gives us $162,000 of variable cost. When we subtract the sales revenue less the variable cost, we get contribution margin of $108,000. subtract out our new fixed cost of $90,000, we have net operating income of $18,000. Therefore, sales increased by 20 grand, but net operating income decreased by $2,000. So the impact of our contribution margin increased by a lesser amount than what our increase in fixed cost did. Contribution margin went up $8,000, fixed cost went up by 10. Not a great idea. So we're $2,000 worse off. A solution to solving this problem incrementally would be to take the increase in contribution margin, 40 units at $200, would be we'd have an additional $8,000 of contribution margin, less the increase in fixed cost, represented by advertising cost, of $10,000, would leave a decrease in net operating income of $2,000. So our profit would decrease by $2,000. Let's look at a second scenario. What's the profit impact if Racing Bicycle can use higher quality raw materials, thus increasing variable cost per unit by $10 to generate an increase in unit sales from 500 to 580? With the idea being that if Racing Bicycle can improve the quality of their product, they can increase their sales volume. If we look at this particular problem, we see that sales volume goes from 500 units to 580 units. Therefore, sales revenue goes from $250 to $290. Our variable cost also increases. It has 580 units with a variable cost per unit of $310. Our variable costs are $179,800. When we subtract our variable cost from our sales revenue, we have contribution margin of $110,200 less our fixed cost of $80,000. We have net operating income of $30,200. This appears to be a real winner, as sales increase by 40 grand, net operating income increases by $10,200. So here in solving this problem, keep in mind our revenue changes solely due to the fact that we have 80 more units. Our variable cost changes also because we sold 80 more units, but it changes also because our variable cost per unit has increased by $10 per unit. Now, at this point in the lecture, let's take a look at exercise 5-5. Exercise 5-5, part 2. I want you to look at exercise 5-5, part 2. 5-5 is on page 214 in the textbook. And then we'll come back, and so you can pause the video, come back, and look at the solution. Now we will discuss the solution to exercise 5-5, part 2. Exercise 5-5 is on page 214. For Heron Corporation, we're giving the per unit sales price, variable cost, contribution margin, as well as the percent of sales. It tells us that fixed costs are $75,000 per month, and the company is currently selling 3,000 units per month. So going back to this original information, in part 2 they say management's considering using higher quality components that would increase the variable cost by $3 per unit. So variable cost would now be $48 a unit instead of $45. The marketing manager believes that the higher quality product would increase sales by 15% per month. Should the higher quality components be used? A way to look at this product is to look at the current contribution margin compared to what the contribution margin will be if we make this change. So the $3 increase in variable cost will cause unit contribution margin to decrease from $30 to $27. As given in the book, the original contribution margin is $30 per unit. It'll now drop to $27 because the variable cost is increased by $3 a unit. Therefore, we are expected to sell an additional 15% of volume. 3,000 units multiplied by 15% would give us an additional 450 units. That 3,450 units multiplied by the new contribution margin of $27 per unit will yield a contribution margin of $93,150. Compared to the current contribution margin of $90,000 gives a positive change in contribution margin of $3,150. Assuming that there's no other changes to fixed cost, everything else remains the same, the higher quality components appears to be a good idea and should be used. This concludes our discussion of exercise 5-5, part 2.